Welcome back to Wealth Mavericks. On today's episode, we're talking about alternative assets and the huge benefits they offer high-income earners.
If you want a tax benefit down the road, if you want to structure some kind of plan to reduce your tax liability but increase some of your cash flow, yes, you absolutely need to have a diversified, uncorrelated program such as alternative assets.
Welcome back to the podcast. We're glad you're here. And I'm joined again today by Bob Wolf. Bob, how's it going?
Great. How you doing, Erin?
I'm wonderful.
Awesome.
So today we're talking about alternative assets. One of my favorite topics now that I've been with Terra Firma a few years and learned so much. There is just so much here, so many benefits from a wealth building and tax savings perspective. And what I have found surprising in working with so many members now is really how few of them have ventured into this space on their own. And I think it's because they have very little knowledge about it, or it can be very intimidating. So a lot of people just avoid it altogether. And so when we're able to introduce them to this space, they're like mind blown. So I want to take a few minutes to demystify it a little bit for our listeners and talk about what this space is, where to start, and how to succeed here. So in looking at our members, the people we work with, even though they make a great income and they're saving a bunch of money, why do you think so many of them have such little knowledge when it comes to other assets?
Couple reasons. One, they're busy. Right? I mean, depending on where they're at in their career of doctoring, they all have families and kids, right? If not, significant others. And if they don't, they spend more time in work. They work more. So they're just busy, I guess, the biggest thing. The great thing about doctors is that they all talk, right? So it does shock me when we hear members that don't know about alternative assets, because I know how much doctors talk to each other about stuff. So that tells me a little bit about that particular member, that they're a little bit more close to the vest. Their child upbringing and their personal upbringing and what the money or this talking about money could be like. And so it's not something that they're open to talking and discussing, and they're kind of to themselves, which that's not a problem. But when it comes to alternative assets, to your point, Erin, it's a whole new world that they have access to. So I don't know which direction you'd like me to go with this.
I guess we should just define it first. Like when
Sure.
people hear that, what are alternative assets?
Yeah. So alternative assets are basically assets that you as an accredited investor, so you have to be an accredited investor, depending on how that particular asset's registered. So we'll just talk about accredited investors because all our viewers are accredited investors. What that means is based on your income or your net worth, not including your primary residence, qualify to these alternative assets. These are assets that anybody who is not an accredited investor has access to. So, great example, most common, multifamily apartment complexes. You go drive down the road and you see this huge 350 unit apartment complex. You're like, whoa, that is nice. More than likely, it's in a alternative asset fund. Investors, you put money in there and you go build this or you go buy this, and you are a limited partner and you own this particular asset, this business. And at the end of the year, they do all their accounting and all their bookkeeping, and they do file their taxes, and you get a K-1 as a limited partner. That K-1 is the IRS's acknowledgement that you earned some sort of income, positive or negative, just like your W-2 is an IRS indication of what type of income you earn. 1099, you get the idea. So the alternative asset could be any asset. They don't say alternative investment properties. They don't say alternative. They're alternative assets. So let me use Robert Kiyosaki's definition of what an asset is. An asset is something that appreciates and grows in value and could create income. Basic. That's an asset. A liability, the opposite, right? Something you owe money to, something that doesn't grow, it pulls away, right? So Alternative meaning it's not normal equities, meaning it's not normal. I can go into my Schwab or Fidelity brokerage account and go invest in those stocks, those mutual funds or ETFs, right? So that's what they mean as alternative. You, as a credit investor, have access to these.
So, multifamily real estate, also things like car washes. Would you call business, like investing in a business as a limited partner, that's an alternative asset?
Yeah, some common terms that some of our members may be familiar with is private equity, hedge
Mm.
funds, right? Those are all funds that you, as an accredited investor, have access to. And what does a private equity firm or a hedge fund go invest in? Other businesses,
Mm.
private equity, right? You're buying businesses to bring it away from the stock market into a private structure of an investment. Okay, so it could be car washes, it could be businesses. Some are very focused. Like there's one that only focuses on blue collar artisan contractor type businesses. So HVAC, plumbers, electricians. That's all they buy are those types of businesses. Usually the managers have an infrastructure and a leadership team that is familiar with that industry. So they can go buy a business, no BS from BS, no truth from truth, and be able to make sure that the investor dollars, your dollars as an accredited investor, just deposited into the fund. They use your money as a manager to go buy this asset. You, as a limited partner, get the benefit in that decision, positive or negative, depending on the accounting and the structure of that.
Sure. So you as an accredited investor have 50,000, 100,000, 200,000, and what do you do with it? You put it into one of these funds as one of the investors. At the end of the year, that K1 flows to your personal tax return.
Yeah.
And a lot of times it's going to give you a negative K1 because you're able to take advantage of bonus depreciation or business write-offs or whatever. So now if you're a W2 earner and you're at $1 million, but now you get this negative K1, it brings your taxable income down.
It could. It could.
It
It's
could.
all based on the structure of the rest of your plan, right? So
Yeah.
that's the misinformation a lot of times is when our members go to their CPA and say, "Hey, can I go just invest in this apartment complex fund and I'm going to get a negative K1? Can we just write it off?" No, at that point it is passive. So you cannot offset it to your active W2 income. So you have to build a structure, an organizational structure, and certain points of how to utilize that as active. Okay. And it's meeting certain rules within the government or the IRS called material participation. That's a whole different dialogue and conversation.
Which we talk about. Exactly.
We do. And so one of the things we need to understand with alternative assets is that it's like when you go invest in a stock or a mutual fund in the sense that you have access to information. It's not just, oh, I'm going to go do this and put my money here and you don't know anything. No, 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 no. There's something called a private placement memorandum. Private placement is the Securities Exchange Commission's terminology of saying, hey, you have this memorandum. It is private placement. So it's a certain area of the Securities Exchange Code and you're able to submit that to the SEC. The SEC doesn't approve or disapprove it. You're just acknowledging and letting them know, hey, we're here, we have this. Okay. So if there's any issues down the road and misdealings or misgivings or anything like that, you filed, they have access to it. You didn't file, ooh, you may get more than a slap on a hand. Right. So it's a communication process. So you'll have a subscription agreement, which is like an application, and there's multiple things within the subscription document. In both of these documents, you'll know how much you're allowed to put into it, how much they're raising. You'll know the manager fees. You'll know the what we call the types of profit share, if you will, of when an asset gets sold, what the managers get, what you get. You'll know the hold period, meaning how long are they going to hold on to your money because it's in a business. You'll know if there's a preferred return, meaning your minimum rate of return that you would receive besides what the actual real return could be. Okay, so if you don't get a real return, you'll get the preferred return. So the bottom line, it's a ton of information. It's a ton of information to be able to make that decision. That could be why some people decide not to go down that pathway. They're like, I don't know what to do, right? And that is a big thing, because there's two main risks when it comes to alternative assets. The investors, meaning you, and I'll explain that in a second, and the managers, the people in charge of the money and buying the assets. Start with you as the investor. You don't know anybody. You're like, if you go invest in Apple, you don't know the other investors in Apple, but Apple's been around, right? Financially, right? They're on every news, or they're one of the biggest companies in the world. You don't need to know other investors, but this is a private placement, and you don't know anybody else who's investing in this. So you're going to invest in it because other people have, but you don't know who those other people are. It's kind of like going to a restaurant and now, Yelp still doesn't exist, or Google reviews don't exist. And you just, like the old days, we risked it. We just went to the restaurant and we just tried it. I know, crazy, but that's what we used to do. We're tough, right? We're warriors. Sarcasm, sorry.
Oh.
So, but at the end of the day, you're making investments because this thing exists, and you're just kind of like, well, I hope, right? The opposite is the managers. You only know what they tell you. You can look at track records and that kind of stuff, but with their fees, you'll know their fees, but you'll know their experience based on their bio. But at the end of the day, what is their skin in the game? Like some of the funds that we work with, like our small bay, our car wash, the ones that we work with our members, they actually, the owners of those and the managers of those, put their own money into the fund as well. They've got skin in the game, so to speak, right? And so there's a value to that. Now, when we set up funds for our members, we don't put money into it and put skin in the game because of our relationship with our members, right? But as managers, you know us, we're everywhere. We've got 2 YouTubes. You've got videos on us. You get to test us out in our discovery. You get into membership and you get to meet with us on Erin on a daily basis, depending on your relationship with your coach or with the asset tax team, right? We're intimately involved. We know each other. There's always access to us. It's not as mysterious. Versus sometimes in the alternative asset space, it is a little more mysterious. You don't get complete access to everybody involved. The smaller funds, the more boutique funds like the ones we work with, you do. I can go text them and say, hey, are you available tomorrow to chat? And then, yeah, this time, great, let's chat, right? That's why we work with those type. That's part of our vetting process and our due diligence. What's my access to you, right? Not everybody does that. Right. And some people feel like, well, that's a negative. Well, I shouldn't have access to you. Why are you so readily available? What are you doing? Do you not have enough time in business? We see it as a valuable part of the relationship because that access reduces the fear, if you will. So those are the kind of, I just threw a bunch of stuff regarding alternative assets, but it's important.
Yeah. So obviously in our membership, we have built this ecosystem of trusted partners, opportunities that are only for our members. They come with preferred returns. We are playing with the end in mind. You always talk about how we're playing chess. So we hold your hand through that. For people who are listening who are not members, but they would like to get into this world, you just talked about the overwhelming amount of information that you can review before going into an asset. And some of our members who've come to us and have been in a few of them have lost their shirt, like they've gone to zero, had failures. And we talked about that on our last episode. You learn from it, you move on. However, you want to avoid that if you can. So
100%.
Out of all that information, what would you say is like the lowest hanging fruit that you should be looking for, that it's probably a better opportunity?
An alternative asset that you feel like you would be comfortable being in. So like multifamily apartment complexes, it's real estate, it's a physical asset. It's something you can go see versus like car washes and businesses. They are physical, but it's a business, it's active, it's cash flow, it's marketing, right? Multifamily apartment complex, everyone needs a roof over their head, right? There's a difference. So that reduces some of the risk, but also with that reduced risk, there's a lot of times the cap rates are a little bit lower, that sort of stuff. That's okay. If you're just getting started, get in something that is safer in nature, if you will. Ask for the private placement memorandum. Ask for the subscription agreement. You shouldn't really have to ask for these. These should be things that are readily available to you. Look at the financials. Even do this. Go into ChatGPT, go into Claude, go into some AI, and say, hey, can you please review these documents and let me know if there's any red flags or things I need to be concerned about? And upload those documents and let it do the overarching work. It'll give you some things that lead to questions that you can ask the managers about. Hey, I did some research. Here's a red flag that I don't know. How do you guys handle this? And that way what questions do you ask if you don't even know what you're asking questions about? So that's one of the cheat things that I would recommend. We do that, right? I'm not saying to do something we're not doing. That's how we do certain things. Why go through all that work? Let's first blush, let the AI do that work for you. So that would be the first thing I would do. First, something you're comfortable with. Second, get information and ask and talk to the managers about what this looks like. And then maybe just start off with your minimum. A lot of times their minimum's 25 or 50,000. Don't do 200, 250, because even if it sounds amazing, even with our members, we say, hey, look, let's only do X amount, right? And that should be something that you would start off low. Let's see. There should be no urgency for you to have to put more. If they create a lot of urgency, maybe you back away and you look at another project.
Okay, as we wrap up, someone who's listening and they haven't ventured into this world at all, and they're thinking, yeah, I think I want to do this. Or someone's thinking, no, I'll just stick with the stock market. I will just keep all my money in, quote unquote, safe vehicles. What would do you think that everyone who earns a high income should be diversified into alternative assets, or is it just not right for some people?
I think instead of using the word diversified, I think we need to use the word uncorrelated. What that means is that I'm investing my money in assets that are not connected to the stock market, to use your example, right? And that uncorrelation allows for true diversification when economic situations occur. Right? That's important because you can go get real estate in your portfolio, your stock portfolio, REITs, real estate investment trusts, that kind of stuff. And you can go invest in those within that, but you're not diversified. You're still correlated with the stock market, the way they're structured. So yes, I believe, yes, especially if you want a tax benefit down the road, if you want to structure some kind of plan to reduce your tax liability but increase some of your cash flow, yes, you absolutely need to have a diversified, uncorrelated program, such as alternative assets in your plan.
Awesome. All right. So alternative assets, not just for the ultra wealthy or the ultra sophisticated. You can assess it the right way, dip a toe into the water, start small, and then keep going. And of course, we're here to help.
One thing I do want to make sure we acknowledge, sorry, Erin, is we're not giving you any investment advice here. This is literally just for educational purposes only, just for information. So if this is something you're thinking about, you want to do, go find a skilled professional that can help you down this road, that actually can give you advice. This is just a episode talking in generalities.
Love it. Got to do the disclaimer. But if you want to partner in some of this, we're here.
Click the link below.
Bob, thanks as always. Doc, we appreciate you being here and listening. We'll see you next time. Until then, go be a wealth maverick.